It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Friday. Trade truce. The U.S. and China confirm a trade framework has been signed off in recent days. And more deals. The Treasury Department is working with G7 allies to remove the so-called revenge tax proposed by President Trump. And Nike leads sportswear stocks higher as it sees a clear path to recovery ahead. 0.05%. That is how far away we are from this moment for a new all-time high for the S&P. Just given where futures are indicating up 0.33%, we will reach there. It did briefly hit that level yesterday, but didn't close there. NASDAQ 100, we are already at a record. The AI stocks, NVIDIA really leading us higher. When it comes to this Treasury market, we are snapping 7 days of yields declining. That saw the front end drop 25 basis points. Some pushback to that this morning. We're up just over 2 basis points. Your 10-year yield nearly 3 basis points at 427 this morning. Let's now get you some stocks to watch with your pre-market movers is Joe Easton. Hey, Joe.
Hey Danny, it is all about Nike. I'm going to go with Nike because this is a US pre-market show. There should be Nike for all our British listeners. Nike shares are gaining today, but we have also got Amazon on the screen. Now, I think I jumped ahead. I'll take the fault for that one. Nike, we're up almost 10% after better than expected sales for the company, and also all about the outlook, really. They're saying that actually the sales decline not as bad as they had once feared. So that is lifting the stock today. We've seen Adidas or Adidas gaining here in Europe as well today. So keep an eye on sportswear. Then we will do Amazon because they are getting an upgrade over at Exane BNP Paribas, which reckons the AWS cloud business is going to join in all the frenzy, all the party around artificial intelligence. And they think that is the big Mag 7 stock that is going to beat expectations, if any do. Finally, we've got an upgrade for Boeing after a lot of the issues at that company. Of course, a street high price target as well. 275 reckons Redburn. That stock set to jump the highest on the street, that price target. So keep an eye on Boeing. We're up 0.9% at the opening of the pre-market trading, and as usual, check out the before the bell opening wrap on the terminal for a wrap up of all these news and more.
Joe, I just feel compelled to say Adidas, you say correctly, it's a German company, but it's Nike. It's
Thank
Nike.
you. Thank you. Well, it's the quarterly debate. We have to do it every quarter. It's a tradition now.
We do. Lucky us. Joe, thank you so much. And we'll catch up with you later in the hour. And in just moments, we're going to be speaking to Viktor Hjort of BNP Paribas on cautiousness of investors. Later in the hour, Keith Lerner of Truist will be joining me as my co-host for the half hour. But first, Viktor Hjort of BNP Paribas staying alert even as global stocks hover near an all-time high. He writes, quote, investors are still very cautious even as we approach the highs. The main reason dips are so brief and shallow in both equity and credit markets is investors are still very cautious on the macro outlook and don't own enough stocks and bonds. Joining us now is Viktor, Global Head of Credit and Equity Derivatives Strategy at BNP. Viktor, that could be a really powerful tailwind. Should we get more broad participation? What could that look like?
So there is obviously a fair bit of good news. We're heading into what should be a positive earnings season, and there is some good news on trade. But I think, this very, very cautious positioning that you're referring to there, that really sets a pretty low bar for what will be perceived as good news. So, when we talk about positioning, there are ways of measuring it. And across both credit and equity investors, what's striking is that positioning is very, very close to neutral, kind of what it was back in 2023 when everyone worried about high rates and recession fears. That's not what you usually associate with the market that's near all-time highs. And, when you look at equities, U.S. equities for the past 4 weeks have actually had outflows. When you look at the credit market, investors have been absorbing very, very heavy volumes of corporate supply, but their cash balances are still unchanged. So this is probably a market that is still way too defensively positioned, and that should be a shock absorber. It should be a tailwind for markets and allowing us to test new highs.
As you say, Viktor, something about that feels so odd. At a time where you have markets at an all-time high or just thereabouts, when the S&P 500 is priced something to perfection at 23 times, does it make you nervous then if we do get more participation in this and we do send equities higher, given all the risks that are ahead and the many macro deadlines approaching us this summer?
Well, yeah, I think the conclusion there is probably that we do need a bit more participation before we start to worry about that. And, when you think about why is it that investors are so gloomy or at least not bullish enough, I think a lot of it can be seen in terms of how they think about the macro outlook. So if you look at Bloomberg data, consensus expects a lot of stagflation going forward. It expects US CPI to average around 3.3% in Q3. It expects US GDP to drop to 0.7% in Q3. And so does the Fed, and so does most people. And that is probably, pretty reasonable outcome. But it does mean that people are set up and prepared for bad news. And therefore, in order to really shock the market negatively, you need those news to be really bad. And the hurdle for bad news is pretty high here.
Just how high is that hurdle? And Victor, I'm asking because July 4th deadline for one big beautiful bill, July 9th reciprocal tariff deadline, although we're getting some news on trade talks even yesterday. Then you get into CPI on July 15th. How do you set up for that? Is that a market you want to be defensively positioned for? Does that make sense?
So that CPI data will be probably very important. It's really the only proper inflation print that we get before the Fed. And obviously, as we know, within the Fed, there's a little bit of a discussion now whether the doves will be able to persuade the majority that we should go for a summer cut. That probability looks pretty low, but it's also not something that the market set up for. Certainly not in credit and equity space. So that inflation print will be very important for how we perform for the rest of the summer. I think if you're looking for upside right now, chances are that US tech is the best source of that. US tech has a lot of important idiosyncratic drivers, specifically with respect to AI. And this could be the earnings season where actually software is the part of AI that gets most attention. But there are more mundane things. The US dollar has been very weak. Tech is the sector that sells most abroad and therefore benefits from that dollar weakness. And then there are some technicals that suggest that things can get very squeezy on the upside because of how the market hedges tech. So tech is probably the way to be positioned for upside going into the earnings season.
Victor, but it hasn't just been earnings, this past earnings, that's allowed stocks to power higher. The new highs, the trend higher also coincided with yields peaking in May, too. To what extent is this rally just about falling discount rates as well?
I think it's certainly part of that story, and clearly there were fears, less about inflation, less about the Fed maybe, but more about pretty fundamental supply-demand issues in the long end of the Treasury curve. And not just the Treasury curve, but long-end curves pretty much everywhere else. What we're seeing right now, and I think the main reason why some of those fears have been alleviated, at least temporarily, is the fact that Treasury departments around the world are sort of leaning into those fears, and they are shortening the maturity profile of debt issuance that is likely to happen in Japan, that may happen in the US, it has happened in the UK, and absolutely, that is offering at least temporary relief on those risks.
Yeah, and Trump just yesterday in a press conference saying we'll probably just extend short-term debt. So rhyming exactly with what you're saying. Victor, so wonderful to speak with you. Enjoy the rest of your Friday and your weekend. Viktor Hjort of BNP Paribas. Now let's get you some other top stories that are trending on the terminal this morning. Iran has denied that nuclear talks with the U.S. are scheduled to resume next week. Iran's foreign minister states that no agreement or arrangement has taken place for negotiations. President Trump said on Wednesday that the two sides would talk next week and, quote, may sign an agreement. Now, on the race for New York City mayor, sources say former New York Governor Andrew Cuomo has no plans of dropping out. That means his name will appear on the ballot in November as an independent. Cuomo lost to Queens lawmaker Zohran Mamdani in the first round of the Democratic primary. Michael Bloomberg, the majority owner of the parent company of Bloomberg News, has endorsed and contributed to Cuomo's campaign. China's industrial firms saw their profits drop 9.1%. That is the most since October. Higher U.S. tariffs and lingering deflationary pressure has weighed on China's economy. Profits of automakers plunged 11.9% on the year. That's the worst drop since the first quarter of 2023. Coming up, more on China. The U.S. signs a deal with the country. Both sides confirm that there is a trade framework, but Beijing is vowing to review exports. We're going to have the latest for you on your Bloomberg Brief coming up next.
So the China deal, we inked the deal. You remember we had a trip to Geneva, and then that was being slow played. We got back together in London, and that deal was signed and sealed 2 days ago.
China said it has confirmed details of a trade framework while also reiterating that it will continue to review exports, writing in a statement. It will, quote, review and approve eligible applications for export of controlled items in accordance with the law. Joining us now is Bloomberg's Adam Blenford. Adam, the deadline for getting these trade deals done fast approaching July 9th. Looks like we have something of a deal for China.
Yes, good morning. It does seem like there's been an agreement. We've got both parties now confirming that. Although it's interesting that it was sort of announced, if that you could say that, without any real fanfare. Howard Lutnick there in your clip saying that the US and China had, as he put it, inked a deal. Remember, that was one that was negotiated in Geneva, and then they had to come back for another round of talks in London to try and get it a little more into gear. And this morning we've had similar confirmation from the Chinese, who have been saying that the progress has been made and that they're looking forward to trying to get some of these details into practice. Of course, signing a deal doesn't mean that everything has started to happen. The key sticking point, as has been for a number of weeks, is about Chinese exports of rare earths, which the US relies on for a whole host of manufacturing and processing magnets that are crucial to a lot of high tech and industrial components. And the US has pledged, if that happens, to remove some countermeasures that it's placed on specific sectors of Chinese industry. So there's still quite a bit of a way to go. We haven't seen the actual outcome of this yet. We haven't seen any necessary moves on the ground. And as you say, Danny, a much bigger global deadline for lots of countries coming in a week or so on July the 9th, when those reciprocal tariffs, as Trump calls them, would come in without any specific deals for other countries.
Well, to that point, Lutnick also talked about other trade deals being signed beyond China. Adam, what's our understanding and where the EU stands on this? An EU leader summit finished last night. I'm sure that was the talk of the town.
Yeah, we had Ursula von der Leyen, the European Commission President, coming out and saying what we've essentially understood has been the EU's position since the beginning, which is that they're prepared to hit back. They haven't, if the US does in fact impose what they would call punitive tariffs. The EU hasn't really revealed what it plans or could plan to do in this instant. They've tried to keep their cards a little close to their chest, while at the same time suggesting that they do have quite big weapons. Of course, they're a large trading bloc with the US, so feel they have quite a bit of leverage. But that one might well go down to the wire. There's clearly a lot to discuss between the EU with its 27 member countries and the US and Trump and both parties have been there has been some difficulty in getting those moving forward. Other deals that are being discussed, Trump was out saying that he was looking forward to perhaps what he called a very big trade deal with India. They've been trying to negotiate that. The Japanese have been making multiple rounds and visits and negotiation talks with the US. And there's been eyes, I think, on places like Vietnam as well, which has been in the focus. Lutnick said to us that he was expecting deals with perhaps 10 countries. So that might be one to keep track of as we head towards July the 9th.
Well, I guess, Adam, the thing to kind of evaluate, and you've been hinting at this, is it a framework? Is it a deal? What details still need to be hammered out to make it reality?
Quite a lot of them, I would say, is the answer. If you look back at the UK, which I think remains the only country to have signed one of these framework deals so far, the key was very much there. It was a framework. There was a lot of stuff still to be worked out, but they were able to do the basics and set out general principles, which meant that the extra levies that the US was planning to impose were reduced. So the UK would currently have that baseline of 10% reciprocal tariffs. They've sort of had to settle for that, and that we have to see whether that's what the US is willing to go to with other partners as well. But every country will have those specific industries which the US has targeted and said that it feels is unfair to US industry and exports. So individually, remember that before this Trump-era trade negotiation started, we were used to trade talks taking months, mostly years, and being really complex, line-by-line negotiations around export codes, categorization of goods, different types of processes and relations between states. This has all been put onto fast forward by the Trump administration. So it's not that surprising that detail is a little lacking sometimes.
Yeah, the last U.S. and China trade deal in Trump 1.0 took 18 months to hammer out. Now they just have over 10 days to figure out the rest of them. Adam, thank you so much. That is Bloomberg's Adam Blenford. Elsewhere in Washington, D.C., the Treasury Department has announced a deal with G7 allies that removes Section 899, or the so-called revenge tax, proposed from President Trump's tax bill. The provision was seen as a way to counter nations from taxing U.S. firms. Joining us now from Washington is Bloomberg's Kasia Klimanshinska. Kasia, I'm sure this is a relief to many.
Good morning. Yes. What a surprise. What a deal. U.S. Treasury Secretary Scott Bessent announced yesterday unexpectedly that there is a deal between the U.S. and other G7 countries where those countries will not tax U.S. corporations under certain OECD rules. There's a major win for the U.S. abroad, but also domestically, as you mentioned, there will be this one section 899, the so-called revenge tax, removed from the big tax and spending bill that is going through Congress right now. So that's again a win, some progress that makes passing this very big bill a little bit easier. It also means that there's one risk removed for those foreign investors, as that section, the revenge tax, the Section 899, would impose higher rates on some individuals and companies from other countries, from the EU, for example, from Canada, from Australia.
So maybe easier on that front to get the tax bill through Washington, D.C. But Kasia, where do divides still appear as Congress tries to get this thing done by the July 4th deadline?
Exactly. So it's a massive bill. It has a lot of Trump campaign promises, such as removing taxes on tips, removing taxes on overtime, and that has to be paid for, at least to some extent, to lower the increase in U.S. deficit. So Republicans were planning to pay for it in part by removing some healthcare spending, and that's where the problem now is, that an official in Senate parliamentarian said Republicans cannot do it without getting some support from Democrats. They cannot pass those taxes with a simple majority.
Kasia, thank you so much for that coverage. That is Bloomberg's Kasia Klimanshinska. Coming up, we're going to have a look at what's making headlines around the world, including a classified briefing on Iran that's leaving U.S. senators divided. We'll have the details for you in your Bloomberg Brief on this Friday morning. Let's take a look at the front pages this morning. What's making headlines around the world? First up, the FT has this: more troubles for Tesla CEO Elon Musk. One of his top lieutenants and closest confidants has left Tesla amid plunging sales and a pivot to autonomous driving, AI, and robotics. Ahmed Ashraf has worked for Tesla since 2017. Sources say it wasn't clear if he will be reassigned to another part of Musk's empire. And in the Washington Post, a classified briefing on the impact of U.S. strikes on Iran's nuclear facilities has left senators split along party lines. Republicans said it reinforced their belief that the strikes were effective. Some Democrats complained that it didn't fully answer their questions. The White House has pushed back against leaked reports that the strikes only set back Iran's nuclear program in a matter of months rather than years. Of course, a very preliminary report. Coming up, trade optimism lifting stocks higher. We're near an all-time record. We're going to catch up with Keith Lerner of Truist, who joins me for the next half an hour. This is Bloomberg. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Friday. Trade truce, the U.S. and China confirm a trade framework has been signed off in recent days. More deals. The Treasury Department works with G7 allies on removing the so-called revenge tax proposed by President Trump. And Nike leads sportswear stocks higher as it sees a clear path to recovery. 0.05%. That's how far away we closed from an all-time high yesterday in the market. Will we get there today? Futures seem to indicate so, up about 0.2%. For the NASDAQ, it's about 1/3 It has been tech leading us higher. Today, we also snapped 7 days of gains for the Treasury market. We are looking at higher yields so far this morning, up 2 basis points for the front end. For your 10-year yield, it is almost 3 basis points over the past 7 days. 2-year yields have fallen 25 basis points. Let's get some stocks to watch this morning. Here with a look is Joe Easton. Hey, Joe.
Hey, Danny. So Nike shares now up around almost 10% in the pre-market trading. Better than expected outlook commentary was the main takeaway from the report last night. HSBC analysts upgrading the stock today, saying that the recovery is going to be a swoosh shape rather than a V shape. I wonder how long they were waiting to use that one, but I thought that was a nice little analogy. The stock gaining, as I say, on the outlook commentary. Rebounding. Air Force Ones doing well. Who doesn't love a pair of Air Force Ones for their trainers? We won't do the Nike debate once again, but that stock is high today. Then moving over to Amazon in the Mag 7, getting an upgrade. BNP Paribas raising this one to outperform. The margins doing better. AWS, the Amazon cloud service, is the area that's going to beat analysts' expectations, according to BNP. They think that is the best stock in the Mag 7. Then moving over to Boeing, it's an upgrade for this one as well. It's over at Redburn, and the highest price target on the street, $275 per share. They think Boeing is worth. They do expect a bit of a reprieve following the recent issues at the company. Boeing shares heading up. We're up around 0.8% at the pre-market. Keep an eye on Boeing later today, Danny.
I'm sure everyone is relieved that we will spare them the linguistics debate. Joe, thank you very much. Joe Easton, thanks for your work all this week. Let's get back to our top story this morning. The U.S. signing a deal with China.
So the China deal, we inked the deal. You remember we had a trip to Geneva, and then that was being slow played. We got back together in London, and that deal was signed and sealed 2 days ago.
China then confirmed the details of a trade framework while also reiterating that it will continue to review exports. Writing in a statement, it will, quote, review and approve eligible applications for export of controlled items in accordance with the law. Joining us now from Washington is Bloomberg's Kasia Klimanshinska. Kasia, the deadline ticking down, but it seems like something of an agreement has been reached with China.
Good morning, indeed. So another win, another surprise yesterday. President Trump, Commerce Secretary Howard Lutnick on Bloomberg TV announced that there is an agreement with China, and China confirmed that. So those talks in Geneva at first and then in London led to some sort of understanding that will unlock some additional trade between the two countries. But that's not the end of trade talks. President Trump is pretty much negotiating with the rest of the world. Remember, on April 2nd, he announced new higher tariffs on all U.S. major trading partners, for some as high as 50%. Those tariffs were then paused, but now we are heading towards July 9th when President Trump said some of those higher tariffs will return if countries don't strike trade deals with the U.S.
Where else are we on the development of those trade deals? Howard Lutnick also talking about 10 other nations possibly. Kasia, what could we hear, and just how detailed will they really be?
Exactly. So Howard Lutnick mentioned 10 countries yesterday. President Trump mentioned India. So we are potentially looking at some sort of an agreement with maybe India, perhaps Japan, Vietnam. We also know that the EU is constantly talking to the U.S., but there is a lot of roadblocks there. So we don't have much time left, so probably they won't be comprehensive big trade deals. There will be just some sort of temporary agreements.
Kasia, thank you so much for your reporting this morning. Kasia Klimanshinska out of Washington, D.C. I'm so pleased to say that joining me now for the next half hour is Keith Lerner, co-CIO and Chief Market Strategist at Truist. Keith, great to see you this morning.
Great to be with you.
Well, the trade headline's the latest thing to help us get something close to an all-time high. Michael Hartnett over at Bank of America noting only 22 stocks are at all-time highs as the index is almost there. How much of an unloved rally, an all-time high is this?
I don't know that it's unloved, but it is somewhat narrow. But the reality, this bull market, the dominant theme has been AI. So it's not a coincidence that what's leading us higher is AI. And what we've seen already is the tech sector is already at an all-time high. So that, to us, that makes sense. But I will say there are some also other pockets doing well. The broker-dealer index yesterday made a fresh all-time high. Industrials are right close to an all-time high as well. You're seeing other areas like, staples and some of the defensive like healthcare underperform, energy underperform after that bump. So, would I prefer to see more stocks participating, more stocks above the 200-day moving average? Yes. But that's really been the theme of this bull market, is the tech side.
Yeah, but it was at the start of this year that part of the reason we said the U.S. started to underperform, besides the Washington, D.C. policy, was the narrowness of it. It was too concentrated. We need to go to Europe. Have we completely forgot about that narrative? Is that not the case anymore?
No, what's an interesting dynamic right now is that growth in the U.S. is working, but value overseas is working. So it's normally, if you said, value and Europe historically have been in the same trade. Now we're seeing a divergence. I think part of that is the policy differential between the U.S. and the ECB, and more importantly, the currency is making that kind of divergence. And I think it's okay. That's what the market's given us. So from our perspective, we're overweight growth in the U.S. We're overweight tech communication services. Over this past couple of months, we've been increasing our exposure to developed international markets as well.
I know that you're still overall neutral, though, on U.S. equities, at least tactically. What makes you go either way?
Well, overall, on our stock bond cash allocation, we're neutral, but we still actually have a bias for U.S. equities. Now, what we've done is we've been underweight international developed for several years. We've moved that more towards a neutral state. So we're still Team USA. But on the margin, I think there's a lot of different scenarios that could play out. We're seeing the U.S. dollar break below this 3-year support level, and having some hedge in the currency side, which you can do through overseas investing, I think makes a lot of sense. And again, there's some policy divergence. We're seeing more stimulus as well. So I think it makes sense to be somewhat less negative relative to the past few years.
The other dynamic in this, though, is with the latest leg higher in equity markets, you've also seen yields come down since their peak in about May. How much of this could you say is really down to just what rates are doing, to falling discount rates, and are vulnerable should we get some of that dovish language ebb at the Fed?
It's part of it. I would say that the biggest thing that for this rally that we're looking at is two things, actually. One is recession risk coming down, right? When the market bottomed, we had recession risk in the poly market putting in odds around 60%. That's down this morning to about 30%. And then the other thing with the rally, it's been moving tick for tick with that policy uncertainty index on Bloomberg that you've seen as policy uncertainty has come down, the market has moved up. Now, I will say that we've used a lot of energy. Like, as that's come down, that's moved the market up. Today, I don't know that the poly market odds of recession are now stabilizing around 30. So yes, yields matter. What the Fed does matters. What inflation does matters. But I do think this. I think if we break above these highs, you'll get some forced buying in. But I also suspect that it may limit the upside because we've used so much energy just to get to where we are, at least on a short-term basis.
Well, it limits the upside, but as we've been talking about, the participation is low. So if you do get forced buying, how powerful is that this time around?
Well, I think to your point, maybe it broadens out more. What's interesting, going back to this breadth of conversation, you look at the equal weight S&P, and that's back at the lows on a relative basis to the S&P. So a lot of folks, were looking for broadening this year. We haven't seen it play out, and it's been somewhat weak. So we actually say, hey, the economy is still cool, and we're in the muddle through camp. We know this AI theme, that there's this secular demand that remains there. You are paying a premium valuation, but if that's the dominant theme, which when you look back at past cycles, that dominant theme tends to continue towards the end. We want to stick more with the growth side, even though we may have some rallies outside of that. And within that, we would say we would focus more on mid caps. That maybe as we see, more of this M&A activity pick up, that would be a beneficiary.
Why not small caps?
Yeah, first of all, mid caps and small caps kind of move in tandem a bit. I would just say small caps are an interesting area because they are cheap. They've been cheap for a while. There's some structural changes in our view with small caps in that a lot of companies, the ones that go on IPO, they're coming out IPO at larger market caps because they're staying private for longer. The private capital markets are taking a lot of these companies, they're not coming to the market as much as well. So listen, if mid caps do well, you'll see a pop in small caps as well. I would just rather be a little bit higher quality, especially given the economic backdrop of we are seeing some cooling in the overall economy.
Keith, I'm pleased to say that you're sticking with us. Much more to discuss. That is Keith Lerner. Let's quickly, though, get you some other top stories that are trending on the terminal this morning. Iran has denied that nuclear talks with the U.S. are scheduled to resume next week. Iran's foreign minister says that no agreement nor arrangement has taken place to start new negotiations. At his news conference from the NATO summit last Wednesday, President Trump said that the U.S. will meet with Iran next week. And on the race for New York City mayor, sources say former New York Governor Andrew Cuomo has no plans of dropping out. That means his name will appear on the ballot in November as an independent. Cuomo lost to Queens lawmaker Zohran Mamdani in the first round of the Democratic primary. Michael Bloomberg, the majority owner of the parent company of Bloomberg News, endorsed and contributed to the Cuomo campaign. And the Treasury Department has announced a deal with G7 allies that will exclude U.S. companies from some taxes imposed by other countries. That's in exchange for killing the Section 899, or the so-called revenge tax, from President Trump's tax bill. Coming up, Nike extending gains in the pre-market as its turnaround plan finally seems to be paying off. We'll have more on that next. This is Bloomberg. You're watching Bloomberg Brief. I'm Danny Berger in New York alongside Keith Lerner of Truist. Now to earnings. Nike extending gains after jumping as much as 11% in the post-market following their earnings yesterday. Pre-market up nearly 10%. The sportswear company's fourth quarter revenue beat estimates, reversing earlier losses. Pitching a clear path to recovery, CEO Elliott Hill said, quote, "From here, we expect our business results to improve. It's time to turn the page." Joining us with the latest is Bloomberg's Katie Linzell. Katie, what did we hear from Nike?
So really, this looks like an improvement for Nike. CEO Elliott Hill is finally seeing some of his strategies start to pay off a bit for investors. They were able to say that on their guidance, it's really better than expected for analysts. It's still a sales decline, but it's better than expected for the current quarter. And I think going forwards, really, it's sort of been years and years in the making, but it looks like things could be looking up for Nike. Really, the performance has been better across the board. In China, still not quite where they'd want it to be. But yeah, finally, it looks like there's positive news here for Nike.
Hey, Katie, it's Keith. So regarding China, that was previously a big growth engine. We're seeing it down 20% as far as on the trends year over year. Who's making up the slack for China right now in their business?
I think we can look to sort of other parts of the globe for that. I mean, in the US, you've also got a weaker consumer there. For Nike, we have like a huge worldwide retail company. So really, they are able to look in other locations to pick up the slack. But yeah, in the US, you've also got some weakness, so it's not necessarily there.
Well, to that point, Katie, Nike, along with many other companies, are going to be feeling the stress of supply chains as they try to figure out even what the deal that was reached in more recent days with China and the U.S. is. What is Nike doing to try to navigate those headwinds?
So Nike is going to be pulling back a bit their reliance on China, and to say that, it's not like China is actually the largest exposure for them, but they have said that over time they're going to be pulling back the amount of reliance they have on China. Vietnam is also another major geography for Nike that is maybe more important, and I understand that there are still talks ongoing to try and get a deal in place with Vietnam. So that's one that's going to be really important for Nike in the coming weeks and months.
Katie, going back to the U.S., mentioned the consumer's also weak here. Was there any optimism on the call that things are actually getting somewhat better, or is it just more of specific to Nike with the competition that they have, that they're kind of restructuring how they're doing things, or is there something on the consumer end that may be a little bit better or maybe a little bit worse?
I think it's going to need to be a case of time and see how this all pans out. Nike, like quite a few other US retailers, have said that they're going to have to be putting in place sort of surgical price increases. That's the language they used. We've seen Lululemon also say that they're going to be having to make price increases, maybe with them demand not being quite so strong to match those price increases. So it's really a case of seeing how the US consumer can cope with these increased prices and where things go from here. But for Nike, overall, the tone is much more positive, and we've got to hope that we can see consumers stand by them in the months to come.
Katie, thank you so much for your excellent reporting this morning. That is Bloomberg's Katie Linzell. And Keith, it has been a moment where, as Katie was pointing to, you've heard a lot of American consumer companies talk about a value-driven consumer. What has been your read on the sector from what we've heard?
Well, I think it's very divergent, as mentioned. And I think the question, even with Nike, as they try maybe a more premium strategy, will people pay up? But, we are still seeing a divergence where people want discounts at one side of it, but they're also willing to pay for higher-end brands as well. So I expect that likely to continue. And the higher-end consumer still seems like they're kind of chugging along, as a whole. I also think it's interesting just how these companies, including Nike, continue to adapt. I mean, even with you talk about supply chains, the currency uncertainty. I mean, that's one thing during this earnings season. We continue to, the last earnings season, that we just see this adaptability that continues.
Adaptability, but we're still not getting the full breadth of guidance we usually do. Nike, another one of the companies, General Mills, earlier in the week saying that we're not giving a full year outlook. As we're at all-time highs, is there a little bit of tension that we still don't have full visibility in what happens to these companies throughout the rest of the year?
Yeah, and it goes back to our earlier conversation. Why do we have somewhat of a narrow market as we break out to new highs? Because people are rotating to where there is secular growth, like technology, communications. And then we think about retail and the discretionary sector. It's such a diverse sector. You're just seeing a lot of more mixed trends. So in some way, I think it makes sense. Listen, we never have clarity exactly about the future. Now it appears even more uncertainty. But I do think there are some things, maybe as we look in the second half, maybe we will get some clarity in that tax bill, right? We're hoping for that. We are seeing some deregulation as well. And at some point, we still think the Fed likely starts to cut rates, maybe if that's 1 or 2. So I think on the margin, maybe we're getting past the worst of uncertainty, and maybe we start to get a little bit more clarity into the second half. And maybe that's what the market's banking on. But with valuations around 22 times earnings on a forward basis, the market is basically anticipating some positive news as we move forward.
Well, to that point, we are going to get more data today. Let's just look at the setup for the day. We're going to have more economic data, PCE, personal spending, income, and spending at 8:30 a.m. Eastern. That will be followed by UMich sentiment survey at 10 a.m. We're going to get some Fed speak. That wraps up the week with Williams, Hammack, and Cook on deck. And finally, the Fed's bank stress test released at 4:30 p.m. It's been a factor that the data has been uneven, especially with things like UMich, where the surveys don't necessarily match economic reality. Have we come almost benumbed to the new data that's coming in just because of the difficulty in understanding exactly where we are in this market regime?
That's right. I think, based on what your narrative is, you can paint a bullish story, a bearish story. And I think in the near term, because there's still questions, is the tariff impact going to start hitting the numbers more recently? I think the employment number next week will be very, very important. I mean, we are seeing in the labor market some cooling, but even there, mixed trends yesterday. Initial jobless claims down, continuing claims at a cycle high. So it's an economy that's cooling. We're expecting around 1.3% growth, but the inflation trends are coming down. We think that will allow the Fed to likely cut rates. And maybe some of those animal spirits that was all discussed late last year come back as we get a little bit of clarity later this year.
I'm sure the bankers would love that. Jefferies out yesterday with some pretty poor earnings because of the drop in M&A. What do you do with the sector right now?
Well, so we are neutral the overall sector, but I say within the sector, there are some strong places, and I would say it's the bigger banks, but also the broker-dealer index, as mentioned earlier, just made an all-time high, and we also have some deregulation there as well. So what we're hearing from our capital markets, too, is that we did see the M&A side really close down, but we are starting to see more optimism out of that, and some deal flow starting again. So I think we're going to see a pickup in M&A. Remember, coming into this year, that's what the expectation was. That was pushed out. I think it's delayed and deferred, but I think we're going to start to see more of that in the second half. So I think it's actually a positive for the broker-dealers in general.
It is kind of crazy that it feels like it took all this time just to get back where we started in the year.
Well, I mean, that's the amazing thing. I mean, I went to one of our recent board meetings and I said, hey, market's flat for the year. Yields are back to where they started. Not much has happened. And also, as I look at the market as a whole, what I do on the S&P is I put kind of a piece of paper at that April decline. And the big picture is we've been 7 months in a trading range. And even tech, which just broke out yesterday, it basically traded sideways since last July. So almost a 1-year trading range. And one of the biggest stocks in there, NVIDIA, also had been trading sideways for that long. So the big picture is we've had a lot of movement, a lot of activity, a lot of news flow, but we really haven't gone too far. Now, the good news is at least we're starting to break above some of these ranges, which I think on a technical basis is a positive.
Keith, my takeaway is we should all go on vacation this summer.
It would have been very helpful to just, if we had the beginning point and the ending point, and just said we could have ignored it in the news.
It could have been the beach the whole time.
A lot less stress, a lot less gray hairs on my side.
Keith, thank you so much for joining this morning. It was such a pleasure to have you. This is Keith Lerner of Truist, and you are watching Bloomberg. It's your Bloomberg Brief. I'm Danny Berger in New York. Wall Street pros often play poker, chess, blackjack, and other games that rely on skills that are highly transferable to their work. In the latest episode of Bullish, Bloomberg's Sonali Basak caught up with the Saba Capital founder, Boaz Weinstein, on the gambler's edge on Wall Street.
The reason blackjack is very similar to what I'm doing in closed-end funds is what I love about closed-end funds is I know the counts. There's the counts in blackjack, there's the discounts in closed-end funds. We're sitting right now at flat count, actually. When there's a discount, the investor has an edge. And in blackjack, when there's big cards to come, the player has an edge. And so we know what the edge is. In blackjack, we know what the odds are. In closed-end funds, there's uncertainty, but we know how cheap we're buying something. I think one of my talents is the ability to process tough times and see the bigger picture. And I think some of it may be connected to feeling lucky as a kid to have been born, coming from a place where my mother, being born in the Warsaw Ghetto, her odds of surviving just simply being a Jewish person born in Poland, out of 3 million Jewish Poles, only 150,000 survived. So understanding that as a kid and feeling so lucky that I'm here, I think that also, plus the learning about loss by games, I think helped me be able to process losing in the markets and trying to keep a cool head.
Saba Capital's Boaz Weinstein with Bloomberg's Sonali Basak, and you can watch that full episode on Bloomberg.com. All right, that is it for your Bloomberg Brief this morning. Surveillance takes it from here on this Friday.